Hello, everyone. Welcome to the Capital Intelligence Channel. Today, we're literally pulling back the curtain on the hidden forces that truly drive stock prices. We're going to bypass the standard, noisy financial news cycle entirely and dig directly into the underlying mechanics that separate everyday retail investors from top-tier institutions.
Look, you really have to ask yourself, what unseen mechanics separate the amateur traders from the institutional pros who consistently generate abnormal returns? While the retail crowd is usually out there reacting to yesterday's headlines, the serious money is quietly navigating a complex web of market pressures, debt structures, and alternative financing. If you're serious about your capital, you absolutely need to understand these hidden layers.
So in today's explainer, we're covering three critical forces. Number one, the bear's arsenal. Number two, the institutional barometer. And number three, backdoor deals. Let's jump right into part one, the bear's arsenal, focusing on short selling and market pressure.
Behind the scenes, the actual flow of a short trade is incredibly complex. It's not just hitting a sell button on a brokerage app. A big player must first locate and borrow a company's shares from a prime broker, post collateral, and then execute that sale into the market. And the ultimate goal? Buy them back cheaper down the road, return the borrowed shares, and pocket the difference. But honestly, that simple premise carries massive complexities. It's a practice defined by a really fierce dichotomy. On one side, critics warn that it borders on outright market manipulation and exposes the shorter to infinite losses, because theoretically, a stock's price can rise forever. But on the flip side, defenders argue short sellers perform an absolutely crucial forensic accounting function. They're essentially the market's immune system, rooting out overvaluation, exposing fraud, and aiding in essential price discovery.
So how do institutions actually survive that risk of infinite loss? Well, they enforce strict, emotionless controls. For example, they completely avoid illiquid microcaps, usually steering clear of anything under $200 million, because borrowing those shares is just too difficult and the price can gap up on them aggressively. They also use pair trading, where they hedge a short position in one company with a long position in a similar company in the exact same sector. And most importantly, they execute rapid stop-loss management. If a short position starts dragging down performance by even a fraction of a percent, boom, the system automatically flags it for closure.
Now let's look at how this builds into an all-out war in the real world. We saw a literal clash of titans a while back when billionaire Bill Ackman aggressively shorted Herbalife. He didn't just quietly take a position, he publicly alleged the whole company was a pyramid scheme, actively trying to drive the price to zero. On the other side, company management, fiercely backed by another billionaire, Carl Icahn, defended their legitimacy, highlighting their risk management and squeezing those short sellers. It was a brutal public battle that perfectly captures the high-stakes world of activist shorting.
But there's a much darker, illegal side to this, and it's called naked shorting. This is where shares are sold short without ever actually being borrowed in the first place. Companies like Overstock, led by former CEO Patrick Byrne, waged massive legal and public wars against this practice. Even former SEC Chairman Harvey Pitt warned that naked shorting could be a fatal attack on a company. Why? Because it artificially inflates the supply of shares, which to completely crush corporate viability. It's a harsh reminder that not all market mechanics play by the rules.
All right, moving on to part two, the institutional barometer. Let's talk about credit and debt. When we look at the corporate balance sheet, we find a metric that amateur equity investors almost always ignore. Retail crowds love to fixate on the bond market when they hear about credit ratings, but serious investors know the real truth. These ratings actually dictate a company's equity prices and its fundamental cost of capital. A rating from a major agency isn't just a grade on a bond. It's a profound signal to the market about cash flow stability, debt levels, and the true underlying strength of the business model. Think about the domino effect of a credit downgrade. It's absolutely brutal for stockholders. First comes the downgrade itself, which instantly raises the company's borrowing costs. And when debt gets more expensive, it eats directly into profit margins, totally shattering long-term earnings predictability. And what happens when institutions can no longer predict earnings? It inevitably triggers a massive, sustained equity sell-off. If you're just watching the stock chart, you're missing the actual trigger pulling the lever. Conversely, let's look at the upside, which is incredible. A credit upgrade doesn't just mean a company gets cheaper loans. It fundamentally expands the investor base. See, many massive institutional funds are restricted by their own charters to only hold investment-grade assets. When a company gets upgraded into that top tier, it basically opens the floodgates. Institutional liquidity pours into the stock, validating management strategy and sparking a long-term re-rating of the stock's overall valuation. And here's the thing, you don't even have to wait for the rating agencies to officially tell you there's a problem. High-level investors track implied debt covenant violations on their own. For instance, if you're digging into an SEC filing and you spot a sudden, sharp drop in a company's current ratio, which is how they measure their ability to pay short-term obligations, that is a screaming hidden red flag. It acts as this crucial early warning system for organizational failure, way before the mainstream financial press ever picks up the story.
Okay, for our final act, let's dive into backdoor deals, specifically pipes and death spirals. We really need to expose the reality of alternative financing here. Get ready for this number, because it's staggering. According to academic research, while standard market investors might earn an average of 3.7% over a typical 384-day period, private investment in public equity, or PIPEs, can generate a massive 19.7% abnormal return. That is a huge risk-adjusted outperformance that simply is not available to the average retail trader who's just buying shares on the open exchange. So, how do PIPEs actually generate those kinds of returns? Well, they operate by offering fast, much-needed cash to struggling small-cap companies. In exchange for throwing them this vital lifeline, private, deep-pocketed investors get to secure restricted stock at massive discounts to the current market price. It lets the company completely bypass the lengthy, expensive traditional IPO or secondary offering route. But make no mistake, it comes at a very steep cost to the existing shareholders. And unfortunately, this mechanism has a catastrophic dark side, known in the industry as death spiral financing. This happens when predatory lenders offer toxic convertible debt. As the stock price drops, that debt converts into more and more shares, triggering just massive, relentless dilution. It completely destroys penny stock valuations, traps everyday retail investors, and frequently prompts SEC fraud charges against the operators running this spiral. It is quite literally a textbook wealth transfer from public shareholders directly to private financiers. So, what is the ultimate takeaway for us here? By understanding how intense short pressure works, how credit shocks fundamentally re-rate equities, and how toxic alternative financing silently dilutes value, you can finally guard your portfolio. You have to start analyzing your investments like an institution would, looking way past the basic price charts and the standard earnings reports. Before you allocate your capital into your next major position, you have to ask yourself a hard question. Are you truly seeing the whole picture? Or are you just buying into the public facade while the real market mechanics work against you? Thank you so much for tuning into this explainer. Stay sharp out there, always do your research, and we'll see you next time.